Today, we're diving into the world of commodities, specifically focusing on crude oil and palm oil. Prices have been on a roller coaster ride this year, influenced by geopolitical tensions, global economic recovery, and even weather patterns. In this video, we will break down the factors affecting their prices, forecast, and where they might be headed by year-end. First, in crude oil prices have surged more than 12% year to June, mostly on geopolitical tensions in the Middle East and Eastern Europe, and tighter fundamentals. We believe the fundamental outlook for crude oil remains constructive for prices to remain elevated through the end of 2024. For the second half of 2024, our forecast is for WTI and Brent oil prices to average $80 and $86 per barrel compared to an average of $79 and $83 per barrel in the first half, respectively. This implies that there could still be room for oil prices to climb higher in the coming months. The basis for higher oil prices is driven by our expectations that the crude oil market may remain in a supply deficit through 2024 if OPEC Plus decides to keep its current output reduction for the rest of the year. Our projections revealed that the crude oil market may experience a sharp supply deficit in the third quarter before narrowing in the fourth quarter. In the third quarter, we believe strong oil demand will be driven by increased transportation activities as summer air travel and road mobility increase the demand for transportation fuel. The current picture remains encouraging. US crude oil and fuel inventories remain below 2019 to 2023 seasonal average, implying that the demand for transportation fuel during the summer driving season remains robust. On the supply side, the extension of OPEC Plus output reduction through September 2024 will keep fundamentals tight. We believe this is necessary given strong production growth outside of OPEC Plus member countries. In the fourth quarter, we anticipate the physical oil deficit to narrow from moderating global demand. We expect volatility in crude oil prices to remain subdued. Despite de-escalation in Israel-Iran tensions remain heightened in the Middle East. In particular, we see any potential short-term supply disruption to be temporary due to the available spare crude oil capacity from OPEC. If OPEC members choose to deploy its spare crude oil capacity, this should prevent tailwinds from Brent oil prices to rally past $92 per barrel in our view. Moving on to crude palm oil, Enver. Palm oil prices have moderated from their 2024 peak in April. What are your views on the price movement in the second half of 2024?
Sure, Jonathan. So, CPO prices have averaged 4,014 ringgit per metric ton so far in the first half of this year. This is roughly about 3% higher compared to the price average compared to the same period last year. We have recently revised our full year 2024 price forecast upwards by 300 ringgit per metric tons to 3,950 ringgit per metric tons, which translates to about 3.6% higher compared to the average price in 2023. These price revisions primarily reflects the elevated CPO prices that we saw in the first half of this year due to supply disruptions caused by El Nino. However, as El Nino has faded in May, we anticipate further price moderation in the coming months, albeit recent trends suggest that the downward price movements may be more gradual. The supply outlook remains largely positive. Malaysia's CPO production rose by 13.5% month-on-month in May, marking the third consecutive month of monthly production growth and confirming the onset of seasonally higher production levels. Encouragingly, the May print brought Malaysia's cumulative year-to-May CPO production to 7.3 million tons, a 9.3% rise compared to the same period last year. With the El Nino index rapidly cooling, wetter weather can be expected in key palm growing regions in Malaysia and Indonesia, which is likely to be supportive of overall yield. Meanwhile, the demand picture continues to be mixed. While the MPOB data showed an 11.7% year-on-year increase in palm oil exports in May, India's imports slowed dramatically to 11.6% from a 40.9% rise in April. In addition, The cumulative year to May of Malaysia's palm oil exports growth of 6.7% underperformed the growth in production. Also factoring into the price dynamics is the narrowing of palm oil discounts over soy oil, which will keep CPO prices range-bound in the coming months with a slight bearish bias. Improved weather conditions in South America will see more soybean supply, coupled with relatively muted demand from China. Both are bearish for soy oil prices and should put a cap in any potential price gains in CPO prices. That will wrap up our commodity analysis today. We look forward to update you again.